Welcome back to the deep dive. Usually, when we sit down to do one of these, we are trying to solve a very specific puzzle.
Right.
We look at the future of biotech, or we try to figure out if electric vehicles have hit some kind of plateau. We zoom in.
Yeah, we usually take a microscope to one specific corner of the economy. We try to get really granular.
Exactly. But today,
Yeah.
today, we are throwing that microscope out the window, and we are grabbing a telescope,
A really big telescope.
a very big one,
Mhm.
because we have a stack of research here, and I mean a literal stack, from Bridgewater Associates, Oak Tree Capital, the World Economic Forum, Brookfield, and all of it. Every single piece is pointing to the same thing.
It is pointing to the fact that the map we have all been using to navigate the world for the last 30, maybe even 40 years,
Wow.
it just doesn't match the territory anymore.
It's February 2026.
Okay.
And if you are listening to this, you already know that the vibes, to use a highly technical economic term, are off.
Off is putting it mildly. I think unsettling is the word I hear most often from clients. It's this persistent feeling that the ground is shifting under your feet.
And you can see it in the headlines. We have gold crossing $4,000 an ounce. I mean, that's a number that would have sounded insane just a few years ago.
Absolutely.
We have trade wars that have stopped being about, tariffs on washing machines and started being about national survival, about who gets the computer chips.
Who controls the supply chains for everything that matters?
Right. And we have AI consuming more electricity than some G7 nations. It feels like everything is happening at once.
And that feeling of chaos, it's completely valid. But the mission for this deep dive is to show you that it isn't random. It's not just a string of bad luck.
It has a logic to it.
It does. It's a cycle, a very predictable and frankly very dangerous historical cycle that we are right in the middle of. Ray Dalio calls it the big cycle.
Okay, let's unpack this.
Yeah.
Because I think a lot of people feel that anxiety, they see it in their grocery prices, they see their portfolio acting weird, but they don't have the framework to understand why. So we're going to break this down. We're going to give you a roadmap.
Okay.
First, we need to talk about where we stand today, specifically this concept that keeps coming up, modern mercantilism.
Which is really the new operating system of the global economy. It's the big one.
Then we need to talk about the sea change in interest rates, why the era of free money is well and truly dead and buried.
And what that means for, well, everything.
We absolutely have to talk about the dollar, the big
Yeah.
one. Is it actually dying, or is that just internet hype?
It's a huge debate.
And finally, we have to talk about the physical reality of AI. It's not just code in the cloud anymore.
No, it's about power grids and nuclear reactors and copper wire. It's very real. And then after all that, we have to answer the big question.
So what?
Exactly. In a world where all the rules have changed, how do you actually protect your wealth? How do you invest?
All right, so let's start at the top, the vibe shift.
Yeah.
You mentioned that historians are going to look back at 2025 and 2026 as a watershed moment. Why? What makes this specific point in time so critical?
Well, it's because we've moved from what you'd call a cyclical change to a secular change. And that's a really important distinction.
Okay, what's the difference?
You see, usually we talk about business cycles. Is the economy growing or is it shrinking? Is unemployment up or is it down? Those are like short-term waves on the ocean. They happen every 5 to 7 years. They come and go.
It's the normal ebb and flow.
It is. But a secular change is different. That's when the ocean currents themselves shift direction.
So the entire environment changes. The fundamental assumptions you were operating under are no longer valid.
Exactly. For the last 40 years, really since the fall of the Berlin Wall, we lived in the era of Pax Americana, the age of globalization. The core idea, the god we worshipped, was efficiency.
Right. And the assumption was that trade brings peace, borders are just sort of suggestions for where goods should cross, and the U.S. dollar is the sun that everything orbits around.
That was the entire model, and it worked for a long time. It lifted hundreds of millions of people out of poverty. It gave consumers in the West access to incredibly cheap goods.
But you're saying that era is over.
It's effectively over. We are now in a new era, and this is where Ray Dalio's framework from Bridgewater is so useful. He calls it the big cycle, and he argues these shifts happen every 75 to 100 years.
I find his framework so compelling because they're terrifyingly simple. He boils it down to 5 major forces, right?
He does, and usually throughout history, a country might have to deal with 1 or 2 of these forces at a time. Maybe you have a debt crisis, but the world is generally at peace.
Or maybe you have a major war, but your domestic economy is strong and the weather is cooperating.
Exactly. You put out one fire, you deal with it, and then you move on. But Dalio's core point, his big warning, is that right now, in early 2026, we are ticking all 5 boxes simultaneously. It is a convergence.
Let's walk through all 5 of them. I want the listener to really feel the pressure cooker that we're in.
Okay, so number 1, debt. And not just normal debt, but massive debt creation. And crucially, the monetization of that debt.
Meaning we're printing money to pay the bills. The central bank is buying the government's debt.
That's it. It's the final stage of a long-term debt cycle. Okay, number 2, internal conflict. The irreconcilable differences we're seeing inside Western democracies, the polarization, the populism from both the left and the right.
It's not just people arguing on social media anymore.
Yeah.
It's a genuine breakdown of the ability to govern.
Precisely. We see it every time a budget needs to be passed or a debt ceiling needs to be raised. It's gridlock. Okay, number 3, external conflict.
Great power competition.
The breakdown of the U.S.-led world order. You have the rise of China as a peer competitor. You have a resurgent Russia. You have the global South finding its voice and challenging the G7's dominance. The world is becoming multipolar. And that's a much more dangerous, unstable environment.
Okay, so that's 3. What's number 4?
Number 4 is acts of nature. Pandemics, obviously, but also major climate events. We're seeing historic droughts shutting down critical shipping lanes like the Panama Canal. We're seeing floods in one part of the world and fires in another, both destroying harvest yields and pushing up food prices.
These are no longer background noise. They are direct economic inputs.
They are. And finally, number 5 is technology.
AI.
The massive disruption of artificial intelligence, which is a force that changes the value of human labor, it fundamentally changes the nature of military power, and it completely upends the information landscape. Disinformation, deep fakes, the very concept of truth.
So you take those 5 ingredients, debt, internal conflict, external conflict, nature, and texture. You put them all in a pot, you turn the heat to high, and you get February 2026.
That's the moment we're in. And the stew that comes out of that pot is this new operating system you mentioned, this term that kept popping up in all the research, modern mercantilism.
Right. Let's really define this. Because when I hear mercantilism, I'm back in 10th grade history class.
Me too.
I'm picturing guys in powdered wigs, trading spices and trying to hoard gold bullion for the king.
Well, it's actually not that far off. Philosophically, we have gone back to the 1700s. Look, for the entire globalization era, the god we worshipped was efficiency.
Just-in-time supply chains.
Exactly. If it was cheaper to build a factory in Vietnam, you built it in Vietnam. If it was cheaper to source a critical component from a single supplier in China, you did that. Companies didn't care about borders or geopolitical risk. They cared about quarterly earnings and profit margins.
And for the most part, governments stayed out of the way. They said, hey, cheap goods for our consumers, lower inflation. Great, go for it.
That was the grand bargain. But modern mercantilism completely flips that script. The primary goal isn't efficiency anymore. The goal is security. It is national strength. It is self-sufficiency.
So the conversation in the boardroom and in the White House, it changes from where can I make this for the lowest possible cost
to where can I make this so that if China blockades Taiwan, or if another pandemic shuts down global shipping, or if the U.S. government sanctions my bank, my country can still function.
It's resilience over efficiency.
That's it. And here's the key. Resilience is expensive. Redundancy is expensive. Bringing manufacturing back home is expensive. And that has huge implications for inflation.
We saw this shift really, really accelerate in 2025, didn't we? Yeah. It felt like the U.S. government finally took the gloves off.
I think 2025 was the tipping point. The U.S. fully shifted into this mode. It wasn't just about tariffs anymore. It was about industrial policy on a scale we haven't seen since World War II.
The CHIPS Act, the Inflation Reduction Act.
Those were the beginning. Now it's the government actively saying, we need to own the entire semiconductor supply chain, from design to fabrication. We need to control the processing of rare earth minerals. We need to dominate the energy transition. And they started using very transactional, sometimes coercive foreign policy to make that happen.
And of course, the rest of the world isn't just sitting there applauding this. They're not just taking it.
No. And this is the really dangerous part of the cycle. The rest of the world, and specifically the countries that have historically been the world's great savers, they are responding in kind.
You're talking about Germany, Japan, South Korea.
Exactly. For decades, these countries ran huge trade surpluses. They made money exporting high-quality cars or electronics to the U.S. And what did they do with that profit, with those dollars?
They invested it back into U.S. treasuries. They bought our debt.
They recycled the money, They funded our deficits, which kept our interest rates low and allowed us to consume more than we produced.
Yeah.
It was a symbiotic relationship.
But now,
But now, in a mercantilist world, they're all saying, wait a minute, we need to look inward. They are keeping that capital at home to build their own factories, to fund their own rearmament, to build their own resilience against an unpredictable America and a rising China.
so the flow of capital, the river of money that supported the U.S. economy for decades, it's not drying up necessarily, but it's diverting.
It is absolutely diverting. And this leads us directly to a concept that I think is even more important than trade war. It's the idea of the capital war.
This term really stuck out to me in the notes. We all know trade war, we know Cold War, but capital war sounds much more, I don't know, systemic.
It is. A trade war is about goods. It's about, I'm going to put a tax on your steel, or you can't sell your solar panels here. A capital war is about the money itself.
The pipes, the plumbing of the global financial system.
It is about weaponizing the financial rails of the global economy. And there was a specific incident mentioned in the research recently, the Greenland incident, that really crystallized this for the markets.
Yeah, let's dig into this because I think a lot of people probably saw the headline and thought it was just more political theater. President Trump threatened tariffs on several European countries, specifically regarding negotiations over Greenland's resources.
Right. On the surface, it sounds like a standard, if aggressive, negotiation tactic. I want access to the rare earth minerals on this territory, so I'll threaten you with taxes on your cars. But you have to look at the market reaction. That's where the real story is.
Okay, so normally, if there's a tariff threat on European cars, you'd expect the stocks of BMW and Volkswagen to dip, maybe some auto parts suppliers.
Correct. But this time was different. Stocks in general went down, which is normal in a risk-off event, but gold ripped higher. And here is the real ticker.
Let me guess. U.S. Treasuries.
U.S. Treasuries government bonds did not act as a safe haven. In fact, they sold off. Usually when investors get scared, they run to the U.S. dollar. They run to the safety of U.S. government bonds.
Because it's the safest house in a bad neighborhood. That's the cliche.
It's been the bedrock assumption for 50 years. But in this incident, bonds sold off too. Why? Because the market sniffed out that this wasn't just about trade. This was about the United States using its economic might to try and force a sovereign concession, not just a trade deal, but access to territory and resources.
So the message the market received was, if the U.S. is willing to do that, is my money really safe in U.S. bonds? What if I'm on the wrong side of their next geopolitical objective?
It's the weaponization aspect. If I lend you money and then you turn around and use that leverage to try and take my house, well, I'm probably going to stop lending you money, or at least demand a much higher interest rate.
That is the capital war. Ray Dalio talks about this extensively. When the global monetary order begins to break down, nations stop cooperating on trade and start actively fighting over capital. And here's the fundamental problem for the U.S.
You cannot effectively fight a capital war when you are the world's biggest debtor nation.
We owe too much money to everyone else to be acting this tough.
Precisely. If we scare away our lenders, the entire system begins to wobble. The math just doesn't work.
Which is the perfect bridge to our next section. The money itself, interest rates, and this mountain of debt. We have this incredible memo from Howard Marks at Oaktree, and he doesn't mince words. He calls this period a sea change.
Howard Marks is a legend for a reason. He has this incredible ability to cut through all the noise and focus on the deep structural currents. And his argument is that for the last 40 years, basically from 1980 to 2021, investors were playing a video game on easy mode.
And the really dangerous part is they thought they were just really good at the game.
They did. He uses this analogy of the moving walkway at the airport, and it's a perfect visualization.
I love this one.
Imagine you are at the airport, you step onto that moving walkway, you start walking at your normal, casual pace, but you are just flying past the people on the regular floor. You look at your reflection in the glass and you think, wow, I am an incredible athlete. Look at my speed. I'm a financial genius.
But really, the floor is moving you. The floor is doing most of the work.
The floor is doing almost all of the work. And in economics, that moving walkway was the relentless decline in interest rates. In 1980, the base interest rate, the Fed funds rate, was around 20%. By 2021, it was zero. That is a 2,000 basis point drop.
Can you help the listener understand the mechanics here? Why does a consistent drop in interest rates make everyone with assets look like a genius?
It's like financial gravity. When interest rates fall, the present value of future cash flows goes up. It's just math.
So the value of assets, stocks, bonds, real estate, everything, it automatically gets a boost.
everything gets a boost. If I can borrow money for nearly free to buy a house, I can afford to pay a much higher price for that house. If a company can borrow for free to buy back its own stock, the stock price goes up. It was this massive 4-decade-long tailwind that lifted all asset prices.
So for 40 years, the wind was at our backs.
A massive tailwind. But Mark's point, the sea change, is that the walkway has stopped. It's over. In fact, it might be starting to move in reverse. We are now in a period of higher for longer interest rates.
And the big question is why? Why can't we just go back to zero? Everyone seemed to like 0% interest rates. The market loved it.
Because of the very mercantilism we just spent 10 minutes discussing. Think about it. Globalization was fundamentally deflationary. You had cheap labor from China and Eastern Europe flooding the market. You had cheap energy from Russia. You had hyper-optimized, efficient supply chains. All of that put downward pressure on prices.
Which allowed the Fed and other central banks to keep rates low without inflation getting out of control.
Exactly. But now, every single one of those trends has reversed. We're building expensive factories in Ohio instead of cheap ones in China. We are reshoring and friendshoring our supply chains. That's expensive.
The green transition is incredibly capital intensive.
That's inflationary. Labor shortages due to demographics are inflationary, so inflation is now sticky. It's structurally higher, and if inflation is sticky, the Federal Reserve simply cannot cut rates back to zero. They have to keep them at 4%, 5%, maybe even 6% just to keep a lid on prices.
Okay, so if the easy money era is officially dead, what happens to all the businesses and investments and entire business models that were built on the assumption that money would be free forever?
They get exposed. Marx has this absolutely brutal line in his memo. When money is free, people fund things that shouldn't exist.
We saw that pretty clearly a few years ago.
We saw it with the SPAC boom, the NFT craze, the legions of unprofitable tech companies that were burning through cash with no path to profitability. When the cost of capital is zero, there's no discipline. When money costs 6%, you actually have to make a profit. You have to generate cash flow.
The tide goes out, and we finally see who is swimming naked.
And it turns out a very large part of the economy is swimming naked. But here is where it gets really complicated. This is the real conflict. We have the Federal Reserve, an independent central bank, trying to keep rates high to fight this sticky inflation. But we have the politicians, and this is a bipartisan issue, both parties, who are absolutely desperate for lower rates.
Because of the debt.
Because of the debt. The U.S. national debt is now so large, it's over 120% of GDP, that every 1% increase in interest rates adds hundreds of billions of dollars to the annual interest bill. It's a fiscal doom loop.
I saw a stat in the World Economic Forum transcript that honestly made my jaw drop. It wasn't even the national debt, it was the NIP, the net international investment position.
That is the scary number we alluded to earlier. Let's define that clearly for everyone. The NIP is basically the scorecard of what the U.S. as a country owes the rest of the world, minus what the rest of the world owes us. It is our net debt to the planet.
Our national balance sheet.
Yes, and that number.
Yeah.
It's at negative 90% of our GDP.
90. So we owe the rest of the world almost a full year of our entire economic output.
And what's worse is that it has nearly doubled in just the last 5 or 6 years. It's accelerating. To put that in context, major creditor nations like China or Japan run huge surpluses. We are in a hole that represents nearly 25% of the entire global GDP.
That feels, the word that comes to mind is unsustainable.
It creates a massive, massive vulnerability. And this is where the capital war we talked about meets this debt trap. We need the rest of the world to keep buying our treasury bonds. We need Japan and Europe and the Middle East to show up at every treasury auction and buy our debt.
But if we're simultaneously weaponizing the dollar through sanctions, and if our own fiscal house is clearly on fire, why would they keep buying?
That's the question. And if they stop buying, or if they demand a much higher interest rate to compensate for the risk, then one of two things has to happen.
Okay.
Either yields skyrocket, which would crash the U.S. housing market, bankrupt the government, and cause a deep recession, or the Fed steps in.
The Fed the buyer of last resort.
The Fed becomes the buyer of last resort. They turn on the printing presses and print the money to buy the government's debt, which is the definition of debt monetization. And in the long run, that leads to one thing: debasement of the currency.
And that word debasement is the perfect bridge to our next huge topic, the dollar itself. Because if the only way out of the debt trap is to print trillions, doesn't that inevitably kill the currency?
That is the trillion-dollar question, and it's probably the fiercest debate in macroeconomics right now.
Yeah, let's get into this, because if I go on social media, the narrative is very clear. It's the dollar is dead, the petrodollar is over, BRICS is launching a gold-backed currency, buy Bitcoin.
It's a very loud, very confident narrative.
It is. But then you read this panel transcript from the World Economic Forum, and you have these very serious people like Kristen Forbes from MIT saying, hold on a minute, not so fast.
It's a classic tug of war between the bear case for the dollar and the bull case. The bear case, the argument that the dollar is dying, is based on everything we just discussed. First and foremost, weaponization.
The Russia sanctions in 2022.
That was the moment when the U.S. and its allies froze Russia's central bank reserves. A psychological line was crossed. It sent a message to every country in the world.
And that message was, your money isn't really yours if we disagree with your foreign policy.
Right. Every central bank governor in the global south, in Brazil, in India, in Saudi Arabia, in Indonesia, they all looked at that and said, whoa, if they can do that to a G20 nation, a nuclear power like Russia, they can absolutely do it to us. It broke the fundamental trust. Money is, at its core, a system of trust.
So as a result, they're diversifying, they're trying to de-risk from the dollar.
Yes. Central banks are actively reducing the share of dollars in their official reserves. They are buying record amounts of gold, which we will definitely get to. And they are also buying what you could call dollar-like currencies.
What's a dollar-like currency?
Think of the Australian dollar or the Canadian dollar. These are countries that are still within the Western sphere. They have the rule of law. They have deep liquid capital markets. They are stable, but they aren't the United States.
They don't carry the same geopolitical baggage.
Exactly. It's a way to stay within the Western system without being all in on American foreign policy and its potential for sanctions. So that's the bear case. Weaponization and fiscal irresponsibility are pushing official state actors away.
Okay, that makes sense. But then you have Kristen Forbes on that WEF panel, and she was pretty adamant that the dollar isn't going anywhere. What's her argument?
She makes the network effect argument, and honestly, it's a very strong, very practical argument. The dollar is like the English language or the TCP/IP protocol for the internet. It's the established global standard.
It's deeply entrenched.
Incredibly, the dollar is on one side of 88% of all foreign exchange transactions on the planet. 88%. It's used for more than 50% of all global trade invoicing. Half of all international loans are denominated in dollars.
Her killer line was, you can't replace something with nothing.
And that's the crux of the bull case. If you want to dump the dollar, what do you replace it with? What's the alternative?
Well, the Europeans would say the euro.
Okay, but the euro has persistent low growth. It has serious political fragmentation issues. Is Italy really the same as Germany? And its bond market is split into 20 different countries. It's not a unified safe asset like U.S. treasuries.
What about the Chinese yuan, the RMB?
That's the other big one people talk about. But China has strict capital controls. It's a feature, not a bug, of their system. You can't easily get your money out of China if you put it in. No one wants a reserve currency that's a roach motel.
And you made this point earlier. China doesn't actually want the yuan to be the world's reserve currency.
They absolutely do not. It would be a prestige move, but an economic disaster for their model. If everyone in the world starts buying yuan to hold in their reserves, the value of the yuan goes up a lot.
If the yuan gets stronger, Chinese exports get more expensive.
Which kills their entire economic model, which is built on selling cheap manufactured goods to the rest of the world. So they talk a big game about de-dollarization, but they have no intention of taking on the responsibility that comes with being the global anchor.
So the dollar basically wins by default. It's the cleanest dirty shirt in the hamper.
For now, it is. And there was a fascinating nuance she brought up regarding the public sector versus the private sector. This is key. Governments, the public sector, are definitely trying to move away from the dollar for political reasons.
The de-risking we talked about.
Exactly. But the private sector, global businesses, commodity traders, international banks, they are actually clinging to the dollar more than ever.
Why?
Because it just works. It's liquid. If you are a Brazilian coffee exporter selling to a Vietnamese coffee shop chain, you aren't going to accept Vietnamese dong. What are you going to do with it? You want dollars. It is the universal translator of commercial value.
And here's the great irony of 2026. Crypto might actually be helping the dollar maintain its dominance.
This is my favorite irony of the current moment. Bitcoin and the crypto ecosystem were created with the explicit goal of destroying fiat currency, of killing the dollar. But what is the single biggest killer app of crypto right now? What is the one thing people actually use it for at scale every single day?
Stablecoins.
Stablecoins, which are just tokenized US dollars. You have people in Argentina, in Turkey, in Nigeria, places where the local currency is collapsing. They're using crypto rails not to escape the dollar, but to get into the dollar.
So technology is actually reinforcing dollar dominance from the bottom up, even as governments try to kill it from the top down.
It's a fascinating dynamic. So you have this huge battle. The public sector is diversifying, but the private sector and new technology are locking it in.
It's a stalemate. But, and there is a big but, there is one asset that sits completely outside of this entire fiat system. It's not someone else's liability. It's not just digital code. It's physical. It's gold.
And this brings us to that headline number, $4,000 an ounce. That is the number Bridgewater highlighted in their research. In this scenario, gold is up 50% year to date. That is a massive, massive move.
And we have to look at how and why it rallied, because this rally broke all the old rules.
Yeah.
Usually, gold and the dollar trade inversely. If the dollar is strong, gold is weak, and vice versa.
Right. And usually gold absolutely hates high interest rates.
Exactly. Gold doesn't pay a dividend. It doesn't pay any interest. If I can get a guaranteed 5% return on a risk-free treasury bond, why on earth would I hold a pet rock in a vault that yields 0?
That is the standard economic logic. It's what they teach you in Finance 101. So with interest rates of 5% and the US dollar being relatively strong against other currencies, gold should have been crushed. It should be at $1,500. Instead, it rallied to $4,000. That tells you the old correlation is broken. Something else is going on.
So what is it? Why are people buying it so aggressively?
Fear. Pure and simple. It's a fear trade. Bridgewater breaks the buying down into two distinct phases. Phase 1 really started after Russia sanctions in 2022. That was the central banks, the sovereign.
The same ones we were just talking about.
The very same. They saw the Russia sanctions and said, I need an asset that is truly sanction-proof. You can freeze a treasury bond account at the New York Fed with a keystroke. You cannot freeze a bar of physical gold sitting in a vault in Shanghai or Singapore.
It's outside the system.
It is the ultimate outside asset. So that was the first wave, the strategic buying by state actors. But phase 2 is what's happening now in this 2026 scenario.
And who is phase 2?
Phase 2 is Western private wealth. This is the hedge funds, the family offices, the high net worth individuals in New York, London, and Zurich. They are looking at the U.S. debt, that negative 90% IIP. They are looking at the political dysfunction and the internal conflict. They're watching the capital war unfold. And they are saying, I need insurance against the system itself.
They want an asset that isn't a promise from a politician or a central banker.
That's the perfect way to put it. A stock is a claim on a company's future earnings. A bond is a claim on a government's future tax receipts. A bank deposit is a claim on a commercial bank. Gold is just gold. It has no counterparty risk. It is nobody else's liability.
But Howard Marks, again playing the role of the rational skeptic, he hates gold. He thinks it's a terrible investment.
Laughs, he does. And his argument is the classic value investing argument. He says gold has no intrinsic value. It doesn't produce cash flow. It doesn't build anything. It doesn't innovate. Its value is purely psychological.
It's only worth $4,000 because someone else, the greater fool, agrees to pay you $4,000 for it.
That's his view. It's a belief system, not a productive asset.
But Bridgewater clearly has a counter to that argument.
They do. They would argue that in a world where governments are actively and openly debasing their currencies to try and inflate away their debt, the intrinsic value of gold is simply that it is finite. You cannot print more of it. It is the only real anchor in a sea of endlessly printed paper money.
So the big question for anyone listening, is it a bubble? At $4,000 an ounce, are we chasing the top? Is this just a panic spike?
That's the key question, and Bridgewater's analysis is nuanced. They suggest that if this Western private demand is a real structural shift in portfolio allocation, then it has a lot more room to run. Most Western portfolios have effectively 0% allocated to gold. If they just move to a historical norm of 2% or 5%, the price has to go much, much higher just to satisfy that demand. But if the geopolitical tensions ease, if by some miracle the U.S. gets its fiscal deficits under control, if trust in the system is restored, then yes, it could crash. It is purely a barometer of anxiety and distrust in the current system.
And it's interesting, in the notes it says that gold has disconnected from Bitcoin and silver too. It's acting completely on its own.
I think that reinforces the fear trade idea. Silver is still largely an industrial metal. Its price moves with the manufacturing economy. And Bitcoin, for all the talk of it being digital gold, still often trades like a risk-on tech asset. It sells off when people get scared. Gold right now is moving purely on geopolitical angst and fears of currency debasement. It's in a class of its own.
Speaking of tech assets in the manufacturing economy,
Mhm.
let's pivot to the other monster in the room, AI.
Yes. The machines, part of our breakdown?
But we aren't going to talk about chatbots or large language models or the code itself. We're talking about the physical reality of AI. We have sources here from Brookfield, Bruce Flatt, who is one of the biggest real asset investors in the world, and he is saying the bottleneck for AI isn't chips anymore, it's power.
This is the part of the AI story that people are finally waking up to in 2026. For the last few years, the entire narrative was all about NVIDIA. It was all about the GPUs, the specialized chips. But those chips are just expensive paperweights without electricity, massive, massive amounts of electricity.
Flatt's quote was, "The bottleneck in AI for the next 10 years is power. The data centers being designed and built today consume as much power as a mid-sized city."
The numbers are absolutely staggering. And you can't just plug a new city's worth of demand into the existing electrical grid. The grid is already at capacity in many places. So AI has rapidly moved from a software story to a hardware and infrastructure story. It is a massive global construction project.
And Brookfield is putting their money where their mouth is. They did that massive deal with Westinghouse, the nuclear power company.
Nuclear is really the only solution that scales for what these massive AI data centers need. You can't run a trillion-dollar AI model on solar and wind alone. You need baseload power. You need a source of electricity that is on 247, 365 days a year, rain or shine. And right now, that means nuclear or natural gas.
So we are actually seeing a nuclear renaissance driven by AI demand.
We are, and this is where it loops all the way back to mercantilism. The U.S. government is heavily involved now, too. The government realizes that AI supremacy is a national security issue. If they want to win the AI war against China, they can't just have the best code and the best chips. They need the best infrastructure. They need energy dominance.
So you're seeing the Department of Energy partnering with private equity firms like Brookfield to rebuild the entire nuclear supply chain in North America. It's a sovereign AI play.
That's exactly what it is. It's a state-directed effort to secure the physical inputs necessary for AI leadership.
It's just wild to think of AI, which feels so digital and ethereal, driving this massive physical demand for concrete and copper and steel and uranium.
It is the biggest CapEx capital expenditure cycle we have arguably ever seen. And that, of course, creates this investment mania. You have the CEO of Alphabet, Google's parent company, saying on an earnings call, the risk of underinvesting is now greater than the risk of overinvesting.
That is a very dangerous mindset, isn't it? Just spend the money, throw capital at the problem, and we'll figure out the return on investment later.
It is the definition of a bubble mindset. But from their perspective, it's rational. It's existential. If Google or Microsoft misses the boat on AI, their entire business guys. So they have to spend $50 billion, $100 billion a year. Even if they light half of it on fire building things that don't work, they have to do it just to survive.
Howard Marks had a great anecdote in his memo about this mania. He talked about a founder raising money at a $2 billion valuation for a secret AI company.
And she wouldn't even tell the investors what the product was. It was completely secret. And they still gave her the money. That is classic 1999 dot-com bubble behavior. When you have that much capital chasing a single narrative, you're going to get an enormous amount of waste.
But the difference here maybe is that the waste is building physical things, productive capacity.
That's the optimistic case, and I think it's a strong one. In the dot-com bubble, the waste was Super Bowl ads for pets.com. Here, even if some of the AI software doesn't live up to the hype immediately, we are going to be left with a lot of new power plants, new high-voltage transmission lines, and new state-of-the-art data centers.
It's like the railroad boom in the 1800s. A lot of the individual railroad companies went bankrupt, but the tracks remained and powered the U.S. economy for the next century.
It's a very similar dynamic. The bubble builds the infrastructure for the next wave of growth.
Okay, wow. So we have painted quite a picture here. A world of fractured geopolitics that we're calling modern mercantilism. A world where easy money is gone and debt levels are dangerously high. We have a capital war where the dollar is being used as a weapon and gold is being used as a shield. And we have a massive physical AI boom that is reshaping the entire energy grid.
It is a lot. It's a complex system with a lot of moving parts.
So if I'm a listener, I'm sitting here thinking, this is overwhelming. What on earth do I do with my money? The old 60-40 portfolio, 60% stocks, 40% bonds, just had its worst run in decades. The old rules don't seem to apply.
And the consensus from all our sources, Bridgewater, Oaktree, Brookfield, is that you're right. The old playbook is dead. You cannot just buy the S&P 500 and go to sleep for 10 years.
Why not? That worked so well for so long.
Because in a world of persistent inflation and higher interest rates, stocks and bonds can go down at the same time. Bonds no longer provide that reliable hedge against a stock market decline. That diversification benefit breaks down when inflation is the primary problem.
So if the old diversification doesn't work, what is the new strategy?
It really boils down to three core principles: true diversification, a focus on real assets, and a renewed emphasis on quality.
Okay, let's break this down one by one. True diversification, what does that mean now?
It means true geographic diversification. Bridgewater is very clear on this. In a world of mercantilism and capital wars, you need to own assets in different countries with different economic systems. If the U.S. is at the center of the conflict, you want some exposure to places that might actually benefit from supply chain shifts. Maybe that's Mexico, maybe it's Vietnam, maybe it's India.
You want to be outside the potential blast zone.
Exactly, and it also means true asset class diversification.
So not just stocks and bonds.
Right. You need to balance growth assets like tech stocks with real inflation protection assets. That means gold. That means commodities. That means owning things that tend to go up when the value of paper money goes down.
Most people today are 100% allocated to growth and 0% allocated to protection.
Okay, the second principle was the real assets play. This is Brookfield's core pitch.
Yes. This means owning infrastructure, power lines, data centers, pipelines, ports. In a world of mercantilism, where every nation is trying to reindustrialize and secure its supply chains, the stuff that makes the economy physically function becomes incredibly valuable.
And it's hard to build new ones. They have moats.
Huge moats. You can't just pop up a new power grid or a new port overnight. It takes years and billions of dollars in permits and construction. So if you own the existing infrastructure, you have immense pricing power.
You can't replace something with nothing. Applies to physical assets, too.
It absolutely does. And finally, the third principle, which is pure Howard Marks: quality.
Cash flow is king. In a high interest rate world, fundamentals matter again. You need companies that generate actual real cash flow today, not just promises of hypothetical cash flow in 2035. When money costs 6%, the discount rate you apply to those future earnings is painful.
You want companies that can fund their own growth, that don't need to constantly go to the bank or the capital markets for money.
Exactly. You want businesses with pricing power that can pass on inflationary costs. You want strong balance sheets. The boring stuff is back in style.
So no more investing in secret AI companies with no product and a $2 billion valuation.
Probably not the safest bet for your retirement fund, no.
Okay, so to synthesize all of this for the listener, we are in February 2026. The world has fundamentally shifted from a focus on efficiency to a focus on security. That means higher costs, more friction, and more conflict. The capital war is the new front line of geopolitics. The dollar is still king, but the peasants are revolting. Gold is the hedge against the systemic chaos. And AI is a physical juggernaut that is reshaping our energy grid and driving a massive capex cycle.
That is the landscape. And the so what for everyone listening is really simple. You have to be agile. The passive set it and forget it era of the 2010s was an anomaly. It was an artificial paradise created by free money. That era is over. You have to be paying attention to these big macro forces because they are driving investment returns now, not just individual company earnings.
It really feels like we're walking on a tightrope. On one side, we have this incredible, almost science fiction level technological potential with AI, this potential productivity miracle that could solve so many problems.
Yeah.
And on the other side, we have the crushing weight of this old system's debt and the geopolitical anger that's building up.
That is the defining tension of our time. Can the productivity miracle of AI grow the global economy fast enough to outrun the debt crisis of the old system? That is the race we are all watching, whether we realize it or not.
So I want to leave the listener with a final thought, a provocative question based on that capital war concept we discussed.
Okay.
We talked at length about the U.S. weaponizing the dollar to win geopolitical fights.
Yes, using it as a tool of foreign policy.
Right. So here is the question. If the U.S. uses the dollar to win a tactical battle, say, over access to resources in Greenland, or to punish China over Taiwan, or to fund the war in Ukraine, does it risk losing the entire economic war in the long run? Do we destroy the very trust that underpins the dollar's status as the global reserve currency? Is the short-term geopolitical win worth the long-term loss of what the French famously called our exorbitant privilege?
That is the ultimate gamble, because if you squeeze the rest of the world too hard for too long, eventually they will be forced to build a new system that doesn't rely on you. And if that happens, the UN debt problem goes from being manageable to being catastrophic almost overnight. It is a very, very high-stakes game of geopolitical poker, and we are all the chips on the table.
On that cheery note, thank you for listening to this deep dive. We will be back next time to track how this capital war and all these other forces are playing out. Stay curious and stay informed.
And stay diversified.
See you next time.